Yo, what's up, everybody? It is Thursday, May 30th. Tomorrow's the end of the month. So, another down day today. It looks like the NASDAQ kicked in on the downside. It's been hanging up there with the whole NVIDIA story, but today it couldn't hold on. So it came down. Dow was down, S&P was down. Dow has given back almost all of the gains for April and May. NASDAQ and S&P are still they're still pretty much up there, but it looks like they're starting to head down now. We had the second revision of first quarter GDP. Remember, that came in at 1.6%, but now with the second revision, it came in at 1.3%. That's slow growth, folks. And I've been telling you guys, the market's going to follow the economy. It's not the other way around. A lot of people think it's the other way around, but it's not. The market is going to follow the economy. If the economy is expanding, that leads to higher corporate profits. People see that. Investors react to that. They buy stocks. The valuation of stocks goes up because earnings go up, etc. And on the way down, it's the opposite. Earnings growth slows, maybe contracts, and valuation comes down. So yeah, I mean, this is why I've been saying, and let me just repeat what has been my topic now for the last few weeks, is that the net government transfers, aka the deficit, net government transfers are falling compared to last year. They're down 190 billion. That might have even gotten worse in the latest week. We'll see. But like I was saying, that is the reason for the growth slowdown. I mean, when those transfers slow, or when they contract based on there's the swimming pool again. Last year it was at a certain level. This year it's down from that level by 190 billion. So that's just a smaller stock of financial savings in the economy, which can be deployed as investment. So there you have it. That's the reason. And you could say anything you want about the interest rates or the Fed, and I'm sure that whatever you're going to read out there, I'm telling you this right now, and you already know it. Whatever you're going to read out there, or whatever you're going to hear on these ridiculous shows like CNBC and Fox Business, it's going to be 100% about monetary policy. About, is the Fed going to do this? Is the Fed going to do that? I mean, the Fed is talking out two sides of its mouth. You got Fed members, FOMC members. I talked about this lady yesterday, this Lauren Messner. Okay, she said we got to keep it restrictive. And I said yesterday, what's restrictive about 560 billion of interest income transfers into the economy so far this fiscal year? I mean, she doesn't get it. And then you have another guy who came out today, I forget who it was, who said the Fed we're seeing a inflation trend towards our 2% target. Maybe it's trending towards the 2% target because the economy is slowing down. Okay, that's really the reason. It's not their monetary policy that's doing it. Their monetary policy, if it wasn't for the fact that they have interest rates so high for so long, they would have been at their 2% target a long time ago. I mean, how many times do we need to see this example? You got Argentina, you got Turkey, you got these countries that raise interest rates like crazy that's their method of squashing inflation. And the only thing that ever happens every time they raise interest rates is the inflation gets higher, the currency gets weaker. And then you have the opposite situation of Japan, that up until recently actually kept rates negative through the whole entire supposed so-called inflation spike. And they had very mild inflation for a country that imports 100% of its energy. Okay? And I'm going to talk about oil in a second. So the Fed, you got stuff flying out of the Fed both ways. Both ways. And my advice is just don't pay any attention to that. Or if you do want to pay attention to that, you just go the other way. Whoever says something, because it's not based in any real understanding. And I don't care if these people are high level policy people or whatever. It's not based in any kind of understanding of their own policy. So anyway, I think, and I said that, I've been saying that I think second quarter, well, remember, these numbers we're seeing on GDP, that's the first quarter, January, February, March. The second quarter numbers, which we'll get in July, April, May, June, I don't see that doing any better than the 1.3, 1.5% that we're having right now. Because if anything, those net government transfers have slowed even further in the second quarter compared to the first quarter. So I don't see it, like I said a few weeks ago, the Atlanta Fed in its GDP Now forecast, they initially put out a forecast for the second quarter of 4.2%. I mean, that is a really rapid growth rate, and it would be coming off a first quarter of 1.3%. I mean, I said, like, how the heck did they come up with that? And they're usually pretty good. Atlanta Fed GDP Now, its forecast, it's usually pretty good. But that was so way off the charts for me, I couldn't understand that. And sure enough, we've had already in the last 3 weeks, we've had 3 downward revisions of that. But it's still something like 3.5%. I still think that's way, way too high. And they're going to end up revising that down for a 4th week in a row. We'll get that number tomorrow on Friday. Their forecast comes out every Friday. I mean, even if they put it down to 3.2%, even if they put it down to 3%, I still think that is too high based on what I'm seeing with these transfers. And the fact that already in the first quarter, they had to revise the initial GDP estimate down to 1.3%. So it's not good. I mean, this is not a good condition for the stock market. And again, it's all based on these government transfers, these flows, these fiscal flows. It's all based on that. That's the first derivative of everything. I always tell you guys that. That's the first derivative of everything. Let me mention oil, because today we had the EIA weekly petroleum status report that came out. We had a 4.2 million or 4.1 million draw in crude. So crude is down modestly year over year, about 1% down. Gasoline and distillate, I mean, we got plenty of supply, okay? Distillate is up something like 11% over last year, and gasoline is up something like 6% over last year. So that product supply, there's no tightness in that product supply, and that's going to be pressuring gasoline and heating oil prices. All right. One thing I did see, which was pretty strong number, was refiner inputs. Refiner inputs refer to the crude that refineries you know input into their refineries. That's essentially crude oil demand by domestic refineries. That was at the highest level. That jumped up to the highest level, get this, in 5 years. It was like 17.1 million barrels a day. That is blistering. That is really high. So I told you guys last week, or maybe earlier this week, that if oil got above 80, that was a sell level, because we saw that producers the previous week were selling oil futures above 80, okay? Right around 80. And so that's what happened. We popped up over 80, and sure enough, the market pulled back. We're at 77 and change, but I don't think it's going to go much lower than that for now. You know, you maybe could get another 1% on the downside or something, but that refiner input, that crude demand by refineries, and by the way, exports were down a little bit, but they're okay. They're still good. Um, I think the 4 week average on exports, we're up about 8% over last year, okay? But that refiner inputs, crude demand by refineries, very strong, man. Strongest in 5 years. So I don't think it's going that much lower. Now, it could be possible, but again, I like to wait and see the Friday CFTC commitments of traders report, so I know what the oil producers are doing. I always follow them. I've told you guys many, many times that when it comes to a physical commodity, okay, a commodity settled in the actual material, okay, not a cash settlement like the S&P or these other things, but the commodity, physical commodity, you gotta follow the producers, what they're doing. They know better than anyone. They're in the business of producing, buying, selling, merchandising. I mean, they're not, if they're paper trading at all, it's just as a hedge against their, what their position is in the physical market. They know better than anybody. And I look at them religiously every week. What are oil producers doing? What are gold producers doing? Okay, they'll tell you where you need to or how you need to be positioned. They'll tell you just by looking at what they're doing in the market at certain price levels. If you just check certain price levels and see what they did, and that information comes out every Friday, and it's free. It's the CFTC puts it out. And I include a whole breakdown or discussion of that in my MMT Trader report. So for those of you who are interested, you should sign up for the 30-day free trial of MMT Trader. So they are net long. Let me just say that oil producers have been net long oil futures for the past year. Incredible. So they're not bearish. But I've noticed in the last 2 weeks, they've been lowering their selling price, okay? They were selling a couple of weeks ago up around 84. Then last week they were selling at 80. They're still net long, but they're trimming that long position, and they've lowered their selling price. It's not particularly a bullish development. Although I'll repeat again that this number I saw today in that EIA report, 17.1 million barrels a day, refiner inputs of crude. That's the biggest in 5 years, man. So the refineries are sucking up crude oil like crazy. So I don't think it's going anywhere on the downside, at least not right now. But keep in mind that producers, they've been lowering their selling price. That's basically it, folks. I mean, tomorrow's the end of the month, and we got the month of June, which will end the second quarter. And again, it all comes down to economic growth. All right? Like, you got people out there talking about all these things about Fed policy and interest rates and this and that, and how the auction is going, the Treasury auction one day, and then the yield curve and this and that and all this other stuff, which is just like gibberish. It's all about economic growth. And economic growth for our country, the United States, and for most, I wouldn't say most, but for many countries, it's the fiscal authority. That is the first derivative of economic growth. They're the net spender. Okay, in countries that run trade surpluses, that's not the case. Okay, then the net spender is the external. Okay, the external countries, the importers. But in our case, that's why you have to look at the fiscal authority, because the fiscal authority is the net spender, and the spending drives everything. So once you understand that, you could have a pretty concise picture of what the economy is going to look at. And the beauty of this stuff is that these spending items, they're all fixed. You know, it's not like they fluctuate from day to day. I mean, Congress comes up with a budget, and that's it. It's fixed. And a lot of these things, the big ones that I always talk about, are non-discretionary. You got your Social Security, you got Medicare, you got Medicaid, you have defense, which is discretionary, but we all know in the United States it's treated like a non-discretionary item. You need, you know, here's my doggy friends. You need $14 billion for an aircraft carrier, boom, they got $14 billion. You need to give $80 billion to Ukraine, boom, they got $80 billion. So it's like they never ask. When it comes to that stuff, man, forget about it. The roads and the bridges and everything could be crumbling, falling apart, you know, decrepit. But when it comes to spending for defense, boom, the money's already there. All that other stuff, it's like, how are we going to pay for it? Don't blame me. I'm just the messenger. I'm not the guy making policy, all right? So that, and then we have interest now. Interest has become a non-discretionary item. The government is a net payer of interest, and this cockamamie Fed thinking that they're squashing inflation. This Lauren Meister who thinks that Fed policy is restrictive as they're transferring almost $600 billion into the economy so far this year in 8 months. We're not even at a full fiscal year yet. It's crazy, right? I mean, think about it. These are the people running the show. And they know nothing. They know nothing. Anyway, that's it for today, folks. Don't forget, please like and subscribe if you choose to. It really helps the channel. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.